Welcome, everyone, to the Wolf Financial Podcast. That is the Solid Report. Yes, sir. Yes, ladies. It is the Solid Report. Welcome back. Welcome back. We are here on Tuesday, January 13. And I don't know. I thought the market was going to go green. It didn't go green. It went red, and then went green, and went red again, and then went green again. But One Stop Shop OSS ticker has been green all day long. Welcome everyone to the Wolf Financial Show. Let me just take a look at something else over here real quick. All right, so we have an interesting show for you guys. It's been it's about 24 hours since the last time I streamed, which is pretty good timing, right? About once a day is doing pretty good. And we are here to talk about a few things on the board. So we have the headlines flashing across the board with a bunch of different things happening. I can't even keep track of all of it. We're going to dig a little bit into what's happening with Trump right now. Actually, he's talking live right now, and he did make a few comments on some things. One, the credit card 10% cap, the Jerome Powell open inquiry, whatever you want to call it. And of course, people are asking questions about Venezuela and Iran and everything. But we're going to play a little clip from that one. Then after that, we're going to take a look at a 30-second clip where he did say some specific words about Jerome Powell. I'm going to be neutral on this one. I just want the stock market to go up, as you guys do know. We're also going to dig a little bit more into this 10% APR cap rate and what this actually means for a lot of companies. And then we're also going to talk about Intel. It's almost at $50, which is pretty wild to see. AMD and SE Limited are moving pretty crazy today, opposite directions. So it is what it is. No, I am not in OSS. I wish I was in OSS, but sadly, I am not in OSS. But that thing just does not stop going up. Adobe, I'm not too happy about that move either, and I'm not too happy about Meta. But it is what it is. There's nothing you can do, and there's nothing we can do. We just sit down and wait. But what's going on, everyone? Ticker Tap X, what's going on? IA fan, what's going on? Cameron, Sense, Derpy Rock, Awan, what's going on? And I see when I read this, I see the word baggery. And I don't know, that doesn't really mix too openly, but it's all good. Yeah, I know it makes me a little sad too as well. But welcome everyone. Welcome back to the podcast. Let's jump right into it. All right. So first thing on the top, I wanted to go over this thing right here. Ahmed posted this morning, actually not even this morning, just like a few minutes ago. So I wanted to touch on it right now. This is going to be my first time watching this as well. So let's go ahead and see what Trump has to say.
Great numbers. They raise interest rates to try and kill it. So you can never really have the kind of rally you should have. What happens and what we want, we're going to have a lot of great months, a lot of great quarters. I want the market to go up. You announce unbelievable numbers and the market goes down because they know you're going to do everything possible. In the Fed, we have a real stiff in the Fed, but that's for another day. But they raise rates. So everyone says, oh, they announced great numbers. It's great, great, great. And the market goes down because they immediately raise rates. No, when the market goes up, they should lower rates. You want to see 20% and 25%? You want to see what we can do? We've got to go back to an old standard. When there's good news, the market should go up, not go down. Does that make sense to everybody? And that's the way it used to be for most of the time. That's the way you make a country great. But our growth potential is unlimited and could be much higher if we went back to sanity. We're not doing it anymore. We're talking about the head of the Fed, and I want somebody that when the market is doing great, interest rates can go down because our country becomes stronger. See, you view it differently. Our country becomes stronger, and therefore interest rates should go down, not up. They kill every rally. If it's, no matter who, if it's beyond me as president, it's no matter who's president. You have a good quarter, and they want to kill it because they're so petrified of inflation. And growth and inflation don't necessarily go hand in hand. You can have growth and very low inflation. In fact, oftentimes growth is good for low inflation. So we're going to work on that, Scott, right? I think we're going to work on that very hard. I mean it so strongly, it's sickening. We announce good numbers and we see the stock market drops 300 points. I say, what the hell is going on?
So, am I the only one that doesn't look at the Dow? I mean, he said that they released good numbers and the stock market drops 300 points. I think he's referring to, I don't know. I think he's referring to the Dow because if that was over a period of time, it did drop about 300 points recently, but I think he's referring to the Dow. I don't know. A lot of people look at the Dow. think there's like an age limit where it's like, I'm no longer going to look at the Dow. I'm going to look at S&P 500. That's what I'm looking at. And today, the S&P 500, let me bring up the charts over here real quick. Oh, we're actually having a little bit of a good day here when it comes to these windows. Nope, we're not having a good day here. Actually, I'm messing up again. I'm messing up. All right, here we go. So we have the market is just like up and down. Like it was literally just green a second ago. Most of the time I'm actually looking at the Qs because my portfolio is a bit tech heavy, but the market is down about 37 basis points. I mean, we just had a new all-time high yesterday, so you can't really complain if we're down not even 0.5%. Amazon, of course, is down as it usually is. Meta is down as it usually is, or lately, that's really been the case for a while. It's down at 628. Adobe is down 6% today. 6%. Is that wild to think about? Why is Adobe down 6%? Well, I'll tell you the reason why Adobe is down 6%. It is because of this right here. Let me share this screen for you. Oh, that's not the one. Here we go. All right. So one of our good friends, Arya, he actually has an excellent YouTube channel. Shout out to Arya. But basically, he's showing over here, this is actually his price breakdown for valuation of Adobe, which is pretty considerably cheap. Now, we want to go back to the reason why it's down. Wow, that actually was not the one. I think I saw that it was like a major downgrade or a downgrade from someone who was actually bullish on Adobe recently. All right, here we go. So analysts who cover Adobe stock have turned the most bearish on the company since 2013. So we had today that a company or a sell-side firm did go bearish in Adobe and they downgraded the stock, specifically Oppenheimer downgraded Adobe, and it's down about 6%. If we look at this chart over here, this is the recommendation consensus for Adobe, and it is quite possibly the worst we've seen in over a decade. Now, going back to the previous tweet that I had from our boy Arya, I got to tell this guy to change his picture. He needs to look happier in that one. Anyways, where was his Adobe valuation one? Yeah, here it is. All right, so he has over here that Adobe has 5% buybacks, 10% revenue growth. So, did I just say that? 10% revenue growth, free cash flow margins, all right? Even though it has really good free cash flow margins, they're still remaining flat, which means that they're not losing profitability. And 0 multiple expansion. So what he's trying to say is that Adobe's very cheap at today's price. According to his indicators, he thinks the revenue by the end of the year is going to be $30 billion. He thinks the free cash flow per share is going to be about $36. Free cash flow beginning of the year is $9.6 billion, I believe. Let's see here. Free cash flow margins, 42%. Current price to free cash flow is 13-14. He's saying the free cash flow CAGR, compound annual growth, is about 11%, and he's projecting this at 228. So he thinks the company is going to return a CAGR of the average. The base case is 15% here. But he does believe that the company could be worth about $900 in his bull case. Base case is $555, which is that's a 21% CAGR, and that's almost a double from here. So is Adobe going to go into the 200 range? That would be wild to even think about. All right, so here's my issue, and we're going to move on to the rest of it after I give a little bit of a talk in this one. This is some real talk. I do not want to be a bag holder. All right, I don't want to hold stocks that are not the bottom when it comes to certain value perspectives, right? So valuation wise, is Adobe bottoming today? It's very difficult to say if this is going to be bottoming. I mean, like I thought we had the bottom, but now it just made a new 52-week low. Okay. The last time it was trading around here was back in 2022 when we had the ultimate bear market. I thought this was the bottom. This is when I bought right here. And it was great. And boom, kablamo. All right. 4% position. I think now it's like close to 3% position all in shares. I don't want to be a bag holder. I'm sorry. It's very difficult for me to continue holding this company if I see the chart trending downwards. I only like to buy in upper trends or reversals into upper trends. And this is a potential candidate for me to cut this position. And if I do, then I'm probably going to make that decision today before the market closes, or I'll just make the decision tomorrow, whatever it is. But you guys already know, very bullish Zeta. I'm bullish path. This isn't a humongous position, but I am bullish path as well. They're going to be re-excelling revenue for the next 2 years. So that does have that positive mode. Also, they're inflecting on the fourth quarter of profitability, supposedly coming up, which is great to see. Bullish on semiconductor. You guys already know about that. Bullish Amcor, and I have a bunch of other positions here, Hood and Lemonade, great stuff. I don't hold BMNR. This is just the watch list, but we'll talk a little bit more about crypto later on. But do I want to be an Adobe bag holder? Hey, this could turn out to be a great thing, right? This could be $555 in 2028. And I'll be very happy about having a 20% CAGR until then. But the question is it going to be dead money for some time? Or am I going to start losing money for some time? Mind you, not selling means that you didn't lose, right? So if you don't sell, you don't lose. Also, if you don't sell a gain, then you don't gain either. But that's the question here. 3% position. Is this really going to matter if it becomes a 6% position in terms of its actual size, considering today's portfolio size with the 20% CAGR? I don't know. It doesn't really seem worth it to me, in my opinion. I'll make that decision. I'll keep you guys posted on that one. I'll post that update on Twitter, whether I'm actually still in it or not. But, mind you, this was a 3%, 4% position to begin with, and it's all in shares. I don't have any options on it or anything. And it's very difficult to call the bottom of this thing, especially when Wall Street is just completely bearish on it when the market is at all-time highs. Just very difficult for me to do. And plus, I haven't really been in this for a long time. I just got in this a few weeks ago. So, it is what it is. I'd rather cut my losses than to continue looking at a falling knife chart. I'd rather look at something like this. Or I'd rather look at something like this, or even like this. This isn't the best thing to look at, but I really do like their fundamental sides accelerating. A lot of the companies I invest in are either expanding margins or increasing revenue, or both, right? And usually that means that they're associated with a secular trend, right? Is there a secular trend with Adobe? I don't know. This is more of a value play for me, but is there a secular trend with this? In fact, it's the opposite secular trend, but set aside sentiment. The price is kind of telling you this is not the day to be buying the massive dip in Adobe right now to guess at today's bottom. That's the difficult part when it comes to this stuff. And that's a difficult time it comes to when you invest in companies from a valuation perspective, strictly a valuation perspective, where there is no secular trend moat in this company. And unfortunately, Adobe doesn't have that, right? There is one candidate that I do know that had this exact same sentiment. PayPal. That is definitely not PayPal. That's Pipe. Right. So this is another company that is doing what it does best, as always, not losing profitability, not slowing down revenue dramatically, but they are slowly losing market share and so on. This is a very competitive industry. And if you thought this was the bottom, you were wrong. If you thought this was the bottom, you're wrong. If you thought this was the bottom back a year ago, well, you're right for a little bit, but then you're wrong again. This is the type of stuff that I don't want to get involved in, right? I don't want to get involved in things that are not like growing market share, that are slowing down in revenue, or maybe it's not slowing down revenue, but are at least losing market share. It's very difficult to stay in these type of companies. I'm not sure if I want to do it. I'm not a shareholder at PayPal, but it's like, well, if I'm trying to outperform the market and I want to concentrate position the portfolio, I got to make decisions to cut certain things. And I don't know, this is probably going to be one of them. So I'll keep you guys posted on that one. So let's go ahead and move on with the rest of the show. All right. So how did this dude get into Adobe? How did he get in? I don't even know how. Oh yeah, I was looking at the market. All right. So I was looking at the stock market and then I got distracted with Adobe. All right. So we're sitting here. Oh, wow. That is not cool. All right. This window, boom. All right. So we're sitting here near the session lows, but I mean, like, come on, guys, zoom out. This is nothing. This is nothing. Like this is nothing. You know, it'd be really cool to see the Qs make a new all-time high. And we have that tariff catalyst tomorrow. We have more than a few things happening this week. We have the tariffs tomorrow. All right. We already had CPI today, which is great, right? So if I bring up the CPI chart over here, I mean, it was kind of telling you the whole time that CPI was going to be just fine, right? So if I pull up US inflation rate, like we literally came in today at 2.7%, and that's what I was expected to be, right? So does this look like it's going to surprise you to the up or downside? I don't know. I generally don't like to bet in these things, but it's like if I look at this chart, it's like, well, it's not going to be down at 2% tomorrow, and it's not going to be at 4% tomorrow. So it's just going to keep on doing this chopping noise, right? We're basically at where inflation is going to be, right? If we have the Fed being the buyer of last resort for Treasury bonds at $20 billion a month, and then we have Donald Trump supposedly buying $200 billion of mortgage-backed securities to work with the oil, you know, we're going to continue expanding monetary policy. You're going to continue printing. Inflation is going to stay here. As long as it stays tame, I'm cool with that, right? So I don't think inflation is going to be a market mover as much as people thought it was going to be, unless like we surprise in the up or down direction, which we arguably did with core PCE the other time. And the market only went up from there. So like, I don't think the market really cares about inflation anymore. So like, what does the market care about? What does it care about? I think tariffs, we're going to get that tariff decision tomorrow. I think that might be what the market cares about. Let me actually play this other clip, because I think also another thing that the market might care about, but doesn't really think it's going to happen, is this 10% cap on APR rates for credit cards. All right. If we look at some charts here, let's look at how some credit card stocks have been reacting lately to it. All right. So we had Capital One Financial, which is a very big credit issuance agency, or not agency, company. All right. So they acquired Discovery. I forget when they acquired Discovery, but it was sometime last year. So they already had the credit cards that they gave out, and they already did loan out this money. If we do put that cap in, then that means that they're probably going to compress their margins more, because they won't be able to make that much more money off the spread, especially when you go from like 22% APR rates down to 10%, right? So the market definitely thinks that this is going to be an issue, but I don't think the whole market thinks it's going to be an issue. I think only shareholders of these stocks. And see this big red candle here? Like before the announcement even came, it was down like 2.5%. It's like someone knew what was going to happen. But if I look down here, it was down as much as 10%. Now for Capital One Financial, that's actually a pretty decent move. Where did my screen go? Here we go. So that's actually a pretty decent move for Capital One Financial. We did have JP Morgan report earnings today. How did they react to it? Okay, it's down like 4%. All right. So what was the commentary on JP Morgan today? I believe the commentary was really revolving a lot about the credit cards. All right. So CNBC, JP Morgan. All right. Here we go. Let me play this video and see what they got to say about it. It's done. All right. So JP Morgan's down about 4% today, and they very likely Jamie Dimon, the CEO of JP Morgan, said some interesting stuff on that earnings call. I mean, this company usually doesn't drop like 4% like that. I don't want to say it's a super low beta, but it isn't really expected for this company to drop that low on a single day, unless something was like said horrendously on that earnings report. I'm just waiting for this ad to end, and I'm going to play CNBC's clip on like what happened with JP Morgan this morning and some summaries. Hold on. All right, here we go. So let me share this screen.
Picker has those results, and she joins us right now. Hi, Leslie.
Hey, Becky. Yeah, going through these results right now, I see for EPS, the company reporting $5.23 per share. That is excluding the impact from the Apple Card, which impacted EPS by about 60 cents per share. You can see shares up about 1% on these results. Top line was a beat, coming in at $46.767 billion. Analysts were expecting $46.2 billion. for EPS. Net income, $13.025 billion. That was down about 7%. Investment banking fees down about 5% year over year and 11% quarter over quarter. Looking at net charge-offs again, that was impacted by that Apple Card forward purchase, which resulted in about a $2.1 billion reserve build here. Book value per share in the quarter coming in at $126.99 per share. In the release, we have some commentary from Chairman and CEO Jamie Dimon, who said the U.S. economy has remained resilient. While labor markets have softened, conditions do not appear to be worsening. So, some kind of optimistic commentary there. Meanwhile, consumers continue to spend and businesses generally remain healthy. These conditions could persist for some time, particularly with ongoing fiscal stimulus, the benefits of deregulation, and the Fed's recent monetary policy. However, as usual, we remain vigilant, he says, and the markets seem to underappreciate the potential hazards, including from complex geopolitical conditions, the risk of sticky inflation, and elevated asset prices. So shares up about 2% on these fourth quarter results right now, continuing to dig through the release, and we'll let you know what we find, guys.
All right, so it does not appear that when the earnings were released, the commentary didn't come out, but I did pull up this article here that might give a better explanation as to what actually happened on this earnings that the market was actually pretty concerned about. Let me go ahead and share this screen here. All right, so JP Morgan dipped 3% after the company's fourth quarter results beat on top and bottom lines, while company-wide and equities trading revenue increased in the quarter. Investment banking fees fell and missed expectations. Okay, well then this is definitely going to be something right there. So the company makes a lot of money off fees, especially their IB sector or investment banking. That's where a large amount of money is there, so they need those fees to kick in there. But the fact that it missed expectations is something the shareholders probably not happy about. But I also think the company's CFO, Jeremy Barnum, also signaled that the banking industry could push back against Trump's call for a 1-year 10% cap on credit card interest rates, which he declared late Friday. Goldman Sachs followed JP Morgan lower. Okay, so pretty clear here that the banks don't like Trump's decision to have a 1-year 10% cap on credit cards. This is obviously going to affect JP Morgan. If I look at the charts over here, SOFI down again today. SOFI is actually up 2% today, which is pretty interesting to see. So we're getting a little bit of reprieve from this. I think the biggest question is, do markets actually believe this is going to happen? This is supposed to be happening on January 20th. So we have 7 days from now. We have Tuesday, 7 days from now. It's actually pretty interesting. I have a Tesla car appointment on Tuesday. So I will be without a Tesla on Tuesday, most likely. Hopefully, I always pay my credit card balances full, like everyone should be doing every so month. So this 10% cap won't even affect me. But let's see if we have a red day or green day that day today, because it would certainly suck to have the stocks down and also without a Tesla or without my car that day. That would really suck. But hey, Robinhood is green today. We have a bunch of crypto that's green today. So there is another stream. There is another video that I did want to share that there was a bit more discussion on this 10% cap, also from CNBC. Oh, wow, that's cool. Okay, hold on. This is the one I want to share. All right, here we go.
So will a proposal like this turn into policy, and how will this play out for consumers and the stocks? I would think that you see the direction.
I'm not going to play the whole thing. I'm going to play part of it.
And companies might be inclined to say, you know what, we're going to concede something in order to move towards that direction without having to get to 10%.
Fair. And I think there's some middle ground. I mean, 10% is probably a little draconian, but yeah, there is a middle ground. But let's try to play it through the lens of the stock market. You know, Capital One sold off today. It makes sense. It's not a valuation concern here, but I think 60 to 65% of their business is tied to exactly that. Where is this thing going to settle? Well, first of all, the unintended consequences, I believe, will be, okay, we'll ratchet back the rate, but then credit lending probably gets ratcheted down to commensurate with that. So I don't think it's going to do what it's intended to do. But I also think this is going to be somewhat short-lived. I think you buy the sell-off in these names just on valuation. The fact that I understand that earnings are backward-looking, but they report on the 22nd, which is fast approaching, and the quarter's going to be pretty good, I think.
Yeah.
Yeah, I agree with you that it seems somewhat overdone. It's a little bit like mini Liberation Day for these names, but I think that the unintended consequences are great. When you think about, all right, if we got a cap at 10 and we know we've had this sort of credit loss, where does that credit loss come from?
Right.
That person's not going to be able to borrow anymore. The people who do pay back will be able to. That's not how these companies make their money. The revolving balances will go down. That's really where the sort of juice of the business is. I get the intent. I don't know how it would actually come to pass without significant legislative involvement. So I do think it's sort of overdone. I don't know what they need to give up yet at the moment. I think let it play out. Clearly, it's a message that could resonate with voters. Whether you can implement that and how quickly, that's something else.
All right. So we don't need to listen to any more opinions there. We kind of get the gist of it. Banks don't like it. These analysts don't like it, likely because they're long financials. Financials has been performing pretty well for the last few months. In fact, we've seen a lot of rotation out of tech and into financials lately. So clearly they don't like it, right? So who does like this? Who likes the fact that we're going to have a 10% cap on rates? You're not going to see anyone in CNBC say they like it. You know who likes it? The people who are voting like it. And you know what's coming up? The midterms. And you know who needs the midterm votes? The Republicans. And you know what the people who are going to do those votes like to hear? Lower interest rates. I would really think this is the only reason why he's saying it, right? Because like, if the people who own these stocks don't like it, the people who are running some powerful companies in the world don't like it, and Trump says he's going to do it, the question is he actually going to do it? I don't know. He says 10% now. What if 10% ends up becoming like 15% or 16, 70%, 6, 7? What if it ends up being around there, right? I know I was like doing this and I was thinking 6, 7 for some weird reason. Funny thing, I was actually just at the supermarket and someone asked the lady next to me, where can I find this? And she's like, oh, aisle 6 or 7. And like the two people were like pretty old that asked. So like they had no idea. But then she like looked at me and like was like this to me. And I was like, oh yeah, there we go. Anyways, I don't think this is going to go through, or at least I don't think 10% is going to go through. And I think if it does, it's going to be a pretty big shock to the system. Not because it's going to stick around for a while, but because this is going to cause a little bit of uncertainty as far as like what Trump says out of his mouth. Because like let's be honest, guys, half the things he says doesn't actually happen. But if he actually follows through with this, people might start taking the bombs he drops on some of his interviews a lot more seriously than what would happen, which would likely cause more volatility in a lot of people's portfolios, right? So he's already talked about the data center stuff, that a lot of these mega cap companies have to pay for the power for their data centers, right? And if that happens, then they're not going to spend so much money anymore, right? It's just like, there's a certain degree of certainty that comes whenever Trump says certain things like this that are like sporadic and out of the blue that the market takes for granted, right? Because half the time he doesn't really come through with it. But take something like this where it's like 10% cap and like clearly the GSIBs of the entire world or the global systemic impacting banks of the world, the JPMs, Bank of Americas, and so on, they don't like it, right? And the shareholders who own them don't like it either because they're selling off the stock. What if Trump actually does do this? I don't think these stocks are going to trade any higher than where it's today. I think they're going to trade lower. And I think that's going to be a problem. And if it's a problem for them, it's going to be a problem for the stock market. I don't think this is bullish at all. I don't think Trump should do it because I want the market to go up. I mean, obviously, we don't want people paying higher interest on whatever it is, but like we're here for the stock market and like, why would anyone want the stock market to go down? But I do think that this happens, the stock market will likely suffer a little bit. So we got one more week until that one. It can literally just be undone with just one tweet or one truth, right? You have truthsocial.com. Trump posts a lot and then he posts his opinions on there, which are truths on truthsocial.com, a social media platform to find the truth of opinions. I don't know. Anyways, we will see what happens with that one. We have 118 people here on the Google YouTube platform. 20 of you people are on the Wolf Financial, and 98 of you are on my channel. 98 of you guys, head over to the Wolf Financial channel. That's where you're going to be seeing the rest of the stream. Until then, I'm gonna have to cut off the stream off my channel because I really want everyone to be on there. That's where that's basically where I'm streaming everything. So if you're on my channel on YouTube, head over to the Wolf Financial YouTube. You have the comment down there below, which is how you can access it. And we're going to continue with the rest of the segment. We're going to go on for about 15 more minutes, and then that'll be it for the stream. So pretty short one today, but definitely a lot more to talk about tomorrow. So if you're on my channel, head over to Wolf Financial or at Wolf_Financial on the YouTube website. People on Twitter,